On December 19th, 2025, a single data release quietly landed on the desks of economists, traders, and policy analysts around the world. No emergency press conference followed. No breaking news banners flooded television screens. But for anyone who truly understood what they were looking at, the message was unmistakable. Something fundamental had just broken. According to the U.S. Treasury Department's latest report, China's holdings of U.S. Treasury bonds had fallen to $688.7 billion, the lowest level since November 2008, the very height of the global financial crisis. Let that sink in. In 2008, Lehman Brothers collapsed. Global credit markets froze. The world economy stood on the edge of total systemic failure. And yet today, in 2025, China's exposure to U.S. debt has returned to those same crisis-era levels. But here's the part almost no one is talking about. In 2008, China was buying. In 2025, China is selling. That single reversal changes everything. Why this number matters. More than headlines suggest to the casual observer, $688 billion still sounds enormous. After all, what country wouldn't want to hold hundreds of billions in the safest debt instrument on Earth? But context is everything. In November 2013, China held $32 trillion in U.S. Treasuries. At the time, it was America's largest foreign creditor, effectively acting as the financial backstop of the U.S. government. China wasn't just another investor, it was the buyer of last resort, the stabilizing force keeping U.S. borrowing costs low, the silent partner underwriting America's deficits. Fast forward to today. That $132 trillion position has been cut nearly in half, a collapse of over 47%. This is not a minor portfolio adjustment. This is not routine diversification. This is a strategic withdrawal. The $631 billion exit that took 12 years. Since its peak in 2013, China has liquidated approximately $631 billion in U.S. Treasury debt. To understand the scale of this number, consider this. That amount is larger than the entire annual GDP of Sweden or Poland. An economy-sized sum of capital has vanished from America's creditor base. And yet, for most of the past decade, the pace was slow, almost invisible. China sold gradually, carefully, methodically, until now. Why the pace? Suddenly changed. What should truly alarm policymakers is not the total amount sold, it's the speed. In October 2025 alone, China dumped $11.8 billion in U.S. Treasuries. In another recent month, it sold another $11.8 billion. That is not passive rebalancing. That is not a technical adjustment. That is what an exit strategy looks like when it enters its final phase. When large institutions, or governments, decide to leave a market, they don't announce it. They accelerate quietly, hoping liquidity holds long enough to escape without triggering panic. History shows this pattern again and again, and China's recent behavior fits it perfectly. An analogy that makes this uncomfortably clear. Imagine you're planning a vacation. You've booked a flight with an airline you trust. Everything looks normal. But then you notice something strange. Over the past 12 years, that airline has sold off half of its aircraft fleet. Concerning, but manageable. Then, suddenly, in just 1 month, they sell 3 more planes, not for upgrades, not for efficiency, but simply to offload assets. Would you still feel comfortable boarding that flight? Probably not. That is exactly what China is doing with U.S. Treasuries. The plane they're exiting is the American debt market. 2008 versus 2025, the critical difference. No one can ignore. In 2008, the world begged China to buy U.S. debt, and China did. While Western banks collapsed, Beijing stepped in, absorbing treasuries to stabilize the global system. China acted as a lender of last resort when few others could. That decision helped prevent total financial collapse. But today's environment is fundamentally different. In 2025, China is not stabilizing markets. China is not absorbing excess supply. China is reducing exposure. This time, there is no external savior waiting in the wings. The buyer is leaving. Why China once needed U.S. Treasuries? For decades, U.S. Treasuries served 3 critical purposes for China. Currency management treasuries helped China control the value of the yuan while maintaining export competitiveness. Safe reserve storage. The U.S. bond market offered unmatched liquidity and safety. Geopolitical leverage. Holding American debt provided indirect influence in global financial negotiations. But each of these advantages has eroded. What changed in China's strategic thinking? Several forces have converged to make treasuries less attractive to Beijing. Rising U.S. interest rates, increasing mark-to-market losses. Weaponization of the dollar through sanctions. Growing geopolitical hostility. Domestic capital needs inside China. A push toward reserve diversification. But most importantly, Trust has broken down. Holding U.S. debt now carries political and strategic risks, not just financial risk. And when trust disappears, exits accelerate. Why this is not just another data point. Some analysts argue this is overblown. They claim other buyers will simply step in. But history warns us otherwise. Foreign official buyers are not easily replaced. Domestic demand cannot absorb unlimited supply without consequences. And when yields rise too fast, markets crack. China's retreat removes a pillar that supported U.S. borrowing for decades. And once structural supports are removed, systems don't adjust smoothly. They snap. What this means going forward. China's Treasury holdings hitting 2008 levels is not the end of the story. It is the beginning of a more dangerous chapter. A chapter defined by higher borrowing costs, reduced foreign appetite for U.S. debt, greater financial volatility, and a global system adjusting to a world without China as America's silent banker. And this time, there is no guarantee the adjustment will be painless. Markets are not moved by numbers alone. They are moved by intent. And intent is revealed not in what is sold, but how it is sold. For more than a decade, China reduced its U.S. Treasury exposure slowly enough to avoid attention. The pace was measured, predictable, almost polite. But something changed in 2025. The sales stopped looking like passive diversification and started resembling urgency. When a sovereign holder sells nearly $12 billion in a single month, it sends a message, whether intended or not. That message is simple. We no longer want to be here. Why speed matters more than size. A $1 trillion market can absorb almost anything until it can't. The U.S. Treasury market depends on a delicate balance. Continuous issuance, constant demand, stable confidence. When one of the largest historical buyers accelerates its exit, the balance shifts. Even if total holdings remain high, momentum changes psychology. Investors start asking questions they avoided before. Who replaces this buyer? At what price? For how long? And once those questions appear, volatility follows. Who is actually buying U.S. debt now? For years, China absorbed enormous amounts of American debt. So did Japan. But today, both are stepping back. That leaves three main buyers: domestic institutions, the Federal Reserve, private investors. Demanding higher yields each comes with consequences. Domestic institutions are already saturated. The Federal Reserve intervening risks inflation and credibility. Private buyers demand compensation for risk, which means higher interest rates. Why higher yields are not a small problem. Rising yields are often framed as normalization, but normalization becomes dangerous when it happens too fast. Every percentage point increase in yields raises U.S. interest expenses by hundreds of billions, tightens financial conditions, pressures equity valuations, weakens debt-heavy sectors, and most critically, it compounds deficits. America doesn't just have debt. It has rolling debt, constantly refinanced. Higher yields turn refinancing into a feedback loop of rising costs, the hidden cost of losing a creditor. China didn't just buy treasuries, it provided price stability. Large patient holders absorb supply without demanding volatility premiums. They smooth markets, they anchor expectations. Remove them, and markets behave differently. Without China, auctions become more fragile. Bid-to-cover ratios matter more. Small disruptions have outsized effects. This isn't theory. We've seen it before. What happens? When auctions fail, Treasury auctions are supposed to be boring. When they're not, something is wrong. Weak demand leads to higher yields, lower prices, market panic. And once confidence cracks, contagion spreads. Bond markets don't crash loudly, they grind lower, until suddenly they don't. Why China is willing to accept losses. One of the most misunderstood aspects of China's sell-off is this. China is selling at a loss. As yields rise, bond prices fall. That means China is absorbing real, realized losses by exiting now. So why do it? Because strategic exits prioritize risk reduction, not profit. China appears willing to sacrifice returns in exchange for reduced exposure, greater autonomy, lower geopolitical vulnerability. Losses today are preferable to dependence tomorrow. The dollar weaponization factor. Over the past decade, the US dollar has evolved from a neutral reserve currency into a policy tool. Sanctions, asset freezes, financial exclusion. For countries outside the Western alliance, this changed the calculus. Holding dollar-denominated assets now carries political risk. China noticed, so did others. Once reserve assets are seen as conditional, diversification becomes inevitable. This is not just about China. China is the headline, but not the only actor. Other countries are watching closely. If the largest foreign holder can reduce exposure without collapse, others will follow. Not all at once, not dramatically, but steadily. And steady erosion is harder to stop than sudden panic. Why markets are underestimating this shift. Markets are conditioned to focus on inflation prints, rate decisions, short-term earnings. Structural changes unfold quietly. China's exit doesn't trigger alarms immediately. It reshapes the environment slowly. By the time markets react, positioning is already wrong. This is how systemic risk builds, not through explosions, but through complacency. The myth of there will always be a buyer. One of the most dangerous assumptions in finance is this: someone else will step in. History repeatedly proves otherwise. When confidence weakens, buyers step back simultaneously. Liquidity evaporates, prices gap. The Treasury market is deep, but not invincible. Remove enough long-term anchors, and even the deepest markets behave unpredictably. Why this is worse than to the weight? In one key way. In 2008, demand surged for Treasuries. Fear drove buyers toward U.S. debt. Today, fear may drive them away. That inversion changes everything. Back then, the U.S. was the solution. Now, it is increasingly viewed as part of the problem. What China gains by leaving. By reducing Treasury exposure, China frees capital for domestic priorities, reduces vulnerability to sanctions, increases monetary flexibility, signals long-term strategic independence. This is not emotional, it is calculated. And once calculated decisions are made at the sovereign level, reversals are rare. The quiet end of an era. For decades, the global financial system rested on an implicit agreement. China would manufacture. America would consume. Treasuries would balance the equation. That era is ending, not with a crash, but with a withdrawal. And withdrawals are far more destabilizing than collapses. What comes next depends on one question. Can the U.S. replace a buyer that, bought regardless of yield, absorbed supply without panic, acted for strategic reasons, not profit? If the answer is no, then markets must adjust. An adjustment means higher yields, lower asset prices, more volatility, less margin for error. The warning. Hidden in plain sight. China's Treasury holdings didn't fall overnight. They fell on purpose. Every sale was a signal, every reduction a message. The world ignored it until the numbers reached crisis-era levels. And by the time signals become headlines, exits are already underway. Why this time is fundamentally more dangerous? At first glance, comparisons to 2008 seem dramatic. After all, there are no collapsing investment banks, no frozen ATMs, no emergency weekend bailouts. But that is precisely what makes this moment more dangerous. Crises rarely repeat in the same form. They evolve. In 2008, the system broke because private leverage collapsed. In 2025, the risk lies in sovereign confidence. And when confidence breaks at the sovereign level, there is no higher authority to intervene. The debt spiral. No one wants to acknowledge. The United States is not facing a debt problem. It is facing a refinancing problem. Every year, trillions of dollars in existing debt mature and must be rolled over. When interest rates rise, that rollover becomes more expensive, immediately. This is not theoretical. Even small increases in yields translate into hundreds of billions in additional interest costs, larger deficits, more issuance, more pressure on buyers. This creates a feedback loop. Higher debt requires more borrowing. More borrowing requires higher yields. Higher yields worsen the debt. At some point, confidence becomes the only thing holding the system together. Why foreign buyers matter. More than ever, domestic buyers are constrained. Banks face regulatory limits. Pension funds have allocation ceilings. Foreign buyers historically filled the gap. They provided elasticity. They absorbed excess issuance. They stabilized markets during stress. China was the largest of them. Its departure removes flexibility from the system, and rigidity increases fragility. The Federal Reserve's dilemma. When foreign demand weakens, one institution inevitably enters the conversation, the Federal Reserve. But intervention is not free. If the Fed steps in aggressively, inflation risks rise, dollar credibility weakens. Political pressure intensifies. If it does nothing, yields spike. Markets destabilize, government financing tightens. This is not a choice between good and bad. It is a choice between bad and worse. Why this threatens. The dollar's long-term role. The dollar's dominance is not guaranteed by law. It is sustained by trust. Trust that U.S. debt will be honored, markets will remain liquid, assets will remain politically neutral, each pillar is under strain. China's exit sends a signal, not just about treasuries, but about confidence in the system itself. And once trust erodes, it rarely returns quickly. De-dollarization is slow until it isn't. Critics often dismiss de-dollarization because it happens gradually. That's true, until the threshold is crossed. Reserve transitions don't occur linearly. They happen in phases: questioning, diversification, acceleration, realignment. China's behavior suggests the process has moved beyond questioning. Acceleration has begun. Why this will impact ordinary people. This story is not abstract. Higher yields mean more expensive mortgages, higher credit card rates, slower economic growth, tighter financial conditions. Government spending becomes constrained, social programs face pressure, taxes eventually rise, directly or indirectly. Sovereign finance always finds its way into everyday life. Markets don't price structural change. Well, markets excel at pricing known risks. They struggle with paradigm shifts. China, reducing its Treasury exposure, is not a shock event. It is a structural transformation. Those are the hardest to model, the hardest to hedge, and the most damaging when ignored. Why complacency is the greatest risk. The most dangerous phrase in finance is, "This time is different, but manageable." History disagrees. Systems break not because warnings are absent, but because they are normalized. China's sell-off has been visible for years. The mistake was assuming it would never matter. The end of the silent partnership. For decades, an unspoken agreement governed global finance. America would issue debt. China would buy it. Stability would persist. That agreement no longer exists. China is not protesting, not threatening, not posturing. It is simply leaving. And exits are final. What the world is quietly adjusting to governments are recalculating. Central banks are reassessing. Institutions are repositioning, not because of panic, but because of realism. The world is preparing for a future where U.S. debt is less universally desired. Capital is more fragmented. Volatility is structural. This transition will not be smooth. Why? There is no easy replacement. No other country can replace China's role. Not Japan, not Europe, not private capital. China bought for strategic reasons. Others buy for yield. That difference matters. The question that will define the next decade: can the U.S. fund itself at scale without unconditional foreign demand? If yes, stability holds. If no, repricing begins. And repricing does not ask permission. Final warning. China's Treasury holdings did not collapse accidentally. They were reduced deliberately, patiently, strategically. By the time the numbers reached 2008 levels, the decision had already been made. History will not ask whether the warning signs were visible. It will ask why they were ignored. Conclusion. The crash isn't behind us. The crash is not a single moment. It is a process, a slow unwinding of assumptions that defined an era. China's exit from U.S. Treasuries marks the end of a financial relationship that once underpinned global stability. What replaces it will shape markets, governments, and lives for years to come. And the most dangerous part? The system is adjusting, whether anyone is ready or not.